Hello everyone and welcome back to our channel. This presentation is brought to you by Synergy Business Advisors Noida, your trusted business mitra. At Synergy Business Advisors, we assist promoters and companies in raising funds through debentures in a smooth and compliant manner. Debentures are an excellent way for businesses to raise capital without giving up ownership. They provide a borrowing option with fixed interest and clear repayment terms. We help you select the right type of debenture, whether secured, unsecured, convertible or non-convertible, and structure key terms like tenure, interest rate, and security based on your cash flow and business goals. Our end-to-end support ensures proper compliance, builds investors' confidence, and enables seamless execution, allowing promoters to raise funds while maintaining full control of their company. What are debentures? Debentures are debt instruments issued by a company to raise funds. In simple words, the company borrows money from investors and agrees to pay it with fixed rate of interest. Investors become creditors, not owners. There is no dilution of promoters' control. Interest costs are predictable and they are suitable for expansion, refinancing, or working capital needs. Simply put, debentures allow you to raise funds without giving up ownership. Who funds debentures? Debentures are typically funded by investors seeking fixed returns. Depending on the structure and size of the issue, investors may include high net worth individuals seeking predictable income, private investors and family offices, corporate entities deploying surplus funds, NBFCs and financial institutions, institutional investors such as AIF and debt funds, and even strategic partners who prefer structured lending over equity participation. These instruments are especially attractive to investors who want regular interest income, defined tenure, and priority repayment over shareholders. Modes of raising funds for companies. Promoters generally have three major funding routes. First, equity funding. Here, companies raise capital by issuing shares. This strengthens net worth and suits long-term requirements. However, it leads to dilution of ownership and control. Second, debt funding. This allows companies to raise capital without diluting ownership. Instruments like debentures, bonds, and intercorporate deposits provide structured financing and predefined repayment and interest terms. Third way is hybrid instruments. These combine debt and equity features. Initially structured as debt, they can convert into equity later. This gives companies flexibility between immediate funding needs and future ownership planning. Types of debentures. Secured debentures are backed by company assets, offering strong investor protection. A trustee is appointed to monitor the assets and safeguard investors' interests. Unsecured debentures rely only on companies' creditworthiness and are suitable for businesses with a strong financial standing. Convertible debentures can be converted into equity after a specified period, giving investors future upside. Non-convertible debentures or NCDs are pure debt instruments with fixed returns and defined repayment. Foreign currency convertible bonds allow companies to raise funds internationally with an option for investors to convert into equity. Redeemable debentures are issued with a fixed maturity and repaid accordingly to agreed timelines, supporting disciplined financial planning. How do we help? At Synergy Business Advisors, we provide complete fundraising support, including legal and regulatory compliance under Companies Act and SEBI, drafting of an offer document, resolution and agreements, coordination with investors, trustees and intermediaries, and full execution support until successful fund infusion. This is C&IP Praveen Agrawal thanking you for watching. I hope this presentation was helpful. Please subscribe to the channel for more such informative videos. Thank you.